Perfecto. Hello, how is everybody doing today? Give me a second here while I get ourselves situated and we'll get started in just a second. There we go. Perfect. Perfect. All right. So let's get right to it. I'm here to answer your questions. A great way to learn how I work. If you have questions for me and you're watching on Zoom, you can put them in the chat box on Zoom. If you're watching on YouTube, you can put them in the chat box on YouTube and I'll answer them in either place. So let's get started. We'll start with our Zoom audience as always, because they are our Zero to Pitch audience. If you're watching on YouTube and you want to be part of it and you want to be part of my group, all you have to do is just see that link over my left shoulder. You can just scan it and join and be part of the group. That's all you need to do. So anyways, for that, let's get started. And oh my goodness, we have a very long question here. This is about Pakistan's current economic situation, which I have. I'm sorry, I'm laughing, but I have no idea about their current economic situation. But let's see what it says. Stock exchange is going up, but people's buying power has collapsed. Companies are shutting down, and shopping malls are empty. What kind of system is this? In other words, I want to understand why there is such a disconnect between the real economic activity, people's purchasing power, and the stock market's apparent growth. So I don't know about Pakistan, but I do know a reasonable amount about the United States. And there's a very well-known economist here named Paul Krugman, who is talking about why is our stock market up when essentially the economic indicators aren't indicating it should be. And the stock market is kind of at record levels here in the United States, somewhat similar to Pakistan. Probably not as dramatic as Pakistan, but kind of the same idea. So why is it up? What's going on? And what's the reason? So there is an old cartoon, which I used to watch as a kid, and this is what he kind of likened it to, called The Roadrunner. And it was kind of a famous cartoon back in the day. And the Roadrunner was always Roadrunner was, kind of stayed out of trouble, and he was always chased by Wile E. Coyote. And the coyote was chasing Roadrunner, and somehow or other, the coyote would always screw up and get blown up, hit by an anvil or whatever, kind of be suspended in midair, and then suddenly gravity would hit and suddenly it would collapse to the ground. And Krugman's analogy was it was kind of like the Wile E. Coyote economy, or Wile E. Coyote stock market was kind of his explanation for it. And he's right. It was the Wile E. Coyote stock market, and eventually it's going to come down. Gravity will happen too in Pakistan. I can't tell you when, but it'll happen, and the stock market will show the same thing. So then the next question is about decline in exports. I said earlier, Pakistan exports were around 3 billion, but now they've dropped to 32 to 28. Why? I don't know. The question was meant to understand the relationship between export performance and the country's overall economic health. I just don't know. I'm not an expert, so I can't tell you. I mean, many different reasons for it in terms of what's going on. You have to look at the specifics. Buying power versus stock market growth. If the buying power has increased by only 20%, but the stock market has grown by 4 times, what does that mean? It means nothing. It just means that there's a bubble in your stock market, probably, just like I was describing. I want to know the market capitalization, how the market can multiply, how the market capitalization can multiply when real world economy isn't growing proportionally. Don't know the answer. I just don't know. I don't know why, don't know what's going on. There's the stock market is not a perfect indicator of what's going on. Over the long term, the stock market's a very good indicator, but not in the short term. There can be bubbles. There can be things that happen that sounds like what's going on in your particular case. Okay, we'll go to the next question. Jeff Bezos says, when everyone is scared, it's the best time to build. It sounds kind of like a Warren Buffett say, statement. It sounds like the same person's asking me the question again. Okay. All right. I agree. In fact, it's from an entrepreneur standpoint, when should you start a company? Recessions are great times to start a company because there's less competition for everything. There's less competition for employees. There's less competition for vendors that you work with. There's less competition for where you're going to have your facility. So there's less competition for rent. All these things make it easier for you to start a business in a down economy. And then beautifully enough, because the economy is going to go up, just when you're starting to grow, the economy goes up and you have a multiplicative effect because of it. Takes guts, but that's a great time to start. Can you tell us how to understand the market and also any book on it? Okay. We're going into stocks, which really isn't about startups, but I'll answer your question anyways because I've got a reasonable amount of knowledge about this. The best book by far on how to invest and understand markets is The Intelligent Investor by Benjamin Graham. It's probably close to 100 years old now. It's Warren Buffett's Bible in terms of how he learned. In fact, I think he wrote the foreword to one of the latest editions of the book. Highly, highly, highly recommend it. It's not an easy read, but it's a worthwhile read. So that's what I would recommend to you is read that book. So anyways, that's my recommendation. There are probably some other books too, which are good, but that's the best one by far. Okay, let's go to our next question. What if an investor asks you, what are my eyes going on me? Oh, I see. What if an investor asks you if you had no experience to run a business, experience you are fresher, first time, complete stranger to the track record. I think what you're saying is, what if an investor asks you, well, if you've never run a business before, why should you be CEO? I think that's kind of what you're asking. And by the way, most people starting companies is probably, I don't know what the percentages are, but most people are first-time CEOs. So you have to prove you're the right person. You've got to show in your background that everything you've done in your career up to this point, or your education, or your experience has led you to this moment. If you're a young person and you're starting a company, there's nothing wrong with that. Many young people are extremely successful starting companies. Great. Go ahead. Start your business. Do it. And, just say, hey, we know what we're doing. Here's why. Here's the experience we have, etc. And that's how you show that you're the right person. I know I'm making this super simple, but that's essentially it. If you have more experience, you kind of have to show, well, here's what I've learned. Maybe my last job, we had this problem, this exact same problem. My company didn't want to solve it. We did. We know exactly what to do, and now we're solving it. Or you saw this problem in your personal life or whatever. And you have to have a team around you, which is the second piece of this question here. You have to have a team around you over time, and hopefully when you're starting, that shows that you know how to solve the problem and that you've got the right people around you for this. If you have a random bunch of people that are just your buddies and your friends, and they don't have the right experience, that is going to make it more difficult for you. Everybody should have the right experience to do what they're doing. That's usually the mark of a successful company, is that you can show you can recruit, you can show you can bring on really good people, not mediocre people, but really good people to your cause. That's what makes you successful, are those things. So that's what I would suggest is, tell your story about how whatever learned experience, be it in business, in the classroom, personally, whatever it might be, led you to want to solve this problem, and then explain why you and the people around you are the right people to solve this problem. That's what you have to do. Okay, if you have questions for me, you can put them in the chat box on Zoom or YouTube. I'm gonna have a little sip of water. I'm young and I'm really struggling to find a CTO. Most are C players. Okay, so what are you going to do about it? Because I'm glad that you recognize that the C players aren't going to work. The C players will get you killed. So you have to find a way, you know, as somebody taught me years ago, and I'll tell you a quick story about this. Years ago, I was working in this public company, very successful company early on in my career, named Maxim Integrated Products, really successful company. And I was in a meeting. Um, this wasn't early in my this wasn't early in my tenure there. It was more later in my tenure there. And there were all the department heads and myself of all the various divisions of the company. And the CEO was listening to the new vice president of one of the divisions, and CEO Jack Gifford. Jack was kind of a tough guy, and the vice president was complaining it was hard for him to recruit, you know, because the division wasn't quote unquote sexy, and Gifford wasn't having any of it because he didn't suffer fools lightly. And Gifford looked at this fellow. I'm going to call him Peter because I don't want to embarrass him. And he said to him, "You got to sell your ass off." And he said it a lot more emphatically than I did. And Gifford was right. You have to learn to sell your business to other people, not just to investors, but to other people. And by other people, I mean, you have to, this is one of the interesting things about being a CEO and pitching. It's not, you're not just pitching investors, you're pitching future employees, you're pitching future executives. My God, I pitched the landlord so that we could have a place to, you know, call our office. You've got to pitch everybody and you have to sell everybody on your idea and your vision. And just to be really harsh about it, because I think this is true, if you can't sell people on what you're doing and you can't get them to join your cause, then you're not going to have a successful company. So you have to learn how to do this. You have to go create a really good pitch and pitch deck, and you've got to start selling people on it. You've got to get people excited by your vision. That's what we all have to do. That's what I had to do when I started my company. That's what every successful CEO has to do. And you're going to have to do the same thing. So I know it's hard. I know it's challenging. I know it's difficult, yet you're going to have to overcome it and you're going to have to do it. So that's the answer here. Okay, let's go to our next question. Our next question, I'm going to go look at my question log here. Okay, if you have an employee that agrees to join you before you get funded, but doesn't join until after you get funded, how much additional compensation and bonuses did you give the person to join after you get funded? And my answer, which is, so by the way, a really good question, is very simple: none. Zero. Nothing. They would get the same compensation because they're joining afterwards. Why should they get a benefit from agreeing to join and then joining later when the risk is less? There's no benefit. It's great that they agreed to join you. They may not join. So what we did, just to give a little bit more background in our particular case, was we started recruiting engineers for after we got funded. And we had about 10 engineers lined up for after we got funded. And of the 10, 8 joined us. Pretty good number. 8 out of 10, pretty good. Couple people backed out, which is to be expected. So what we did is we just said, okay, here's your salary upon joining. Here's the equity we're going to give you upon joining. Here's the percentage, blah, blah. And then we gave them those packages and we were true to our word. But why should they get more just because they agreed to something? That doesn't make sense. You have to, with equity, you have to be really disciplined about it because you can run out of equity very quickly. And one of the things that drives investors nuts is if you have a, for example, which is probably a standard ESOP, which would be an employee stock option pool, a standard employee stock option pool might be that you're going to have 20% of your equity carved out for 2 years for employees that you hire over those first 2 years. That would be a fairly standard post-funding pool. Well, that's got to last you, depending upon how many employees you're hiring. It could be 30, 40, 50, 60 employees, depending upon the numbers. So you have to be very disciplined in who you're going to give what, because you can run out of that equity very fast, is the point. And you can have no equity before you know it, which is the other point. So what you should do, and I would strongly urge you to do, is have a hiring plan in place so that you know that, okay, we're going to have whatever number of people it's going to be. Month 1, we're going to have 3 people. Month 2, we're going to have 4 people, whatever, all the way through this. And these people are going to be at various levels: director level, manager level, individual contributor, senior individual contributor, et cetera, whatever they are. And then you have to assign equity percentages to them by rank, essentially. And then you have to add it all up and see where you come out. And you have to stick to those disciplines. If you are consistent, it will pay off for you, is kind of my point here. If you are inconsistent, it will not pay off for you, and you'll have more problems, which is the other point I want to raise here, is that and what do I mean by inconsistent? Let's say we have a very senior engineer we're going to bring on. And let's say that the high end of our equity compensation that we're going to give, and by the way, this is true for both salary and stock. But let's just talk about stock and keep it really simple. So let's say at the high end is we would give 0.75%, 0.75%, vesting over 4 years with a 1-year cliff. If we give, and that's our standard, let's say that's at the high end of our range. And maybe there's a variant of, let's say, 0.6% to 0.75%. But now let's say we're not disciplined and we give somebody 1.5%. And now there's this huge variance for the same job. That's what gets you killed. And that's what gets people really upset. You have to assume that every single employee that you hire will know what every other single employee that you hire makes. Every single one. So you have to, so you want to get this really spot on right, is my point in terms of what you're doing here. That's the way to go at this, because it keeps the problems from multiplying for you. There will always be a little bit of discontent, because why is one person getting more than the other person? But by being fair and being consistent, you keep that to a minimum. Just a little simple tip. Okay, we're back to more questions on, I hope that helped, by the way. More questions on the market. So what I want to understand is how to research the market, not as a stock investor, but from an entrepreneur's perspective, to know what's really going on in the market. Could you please guide me on that? Well, I don't know whether I can. All I can do is tell you the market's going to go all over the place, and I think the best thing that you can do. I'm sorry, I'm stopping myself because it's really. There are certain instances where you can that things can happen, and you can have issues happen, and you want to be careful about those issues. Like, for example, there's a lot of talk right now in artificial intelligence that there's a bubble going on. I read a report on it over the weekend. I'm involved in a company where I'm both an investor and an advisor to the company that's doing really well, that's in that space. And I was conversing with the CEO over the weekend about it, and he was going, "Oh yeah, we're potentially seeing a bubble." And then if you read the news yesterday here in the United States, that OpenAI was potentially going to invest in AMD, which is one of the largest chip makers in the space, and AMD's stock shot up by 30%. Those are when you see things like that and you're hearing information like that, then you definitely want to be aware of those various things. But things like this, if the stock market's going up, those are kind of like random events, and I really wouldn't spend a huge amount of time thinking about them, because there's nothing you can do. You want to be talking to your customers consistently as best you can, and understanding what's going on and making whatever adjustments you need to make. And then, because I'm assuming most people who are listening to this are probably in fundraising mode, don't try and time the market in terms of what's the best time to go raise money or the worst time. Go time is go time. When you're ready to get started, get started. The market is what the market is. And there is no good time or bad time. It is just it's just what it is. So deal with whatever situation you have as best you can, and get out there and get going. That's my best advice. The rest of it is really hard, to do. And then trying to make sense of it is even harder, is kind of my point. Okay, and the question keeps going on into buying power. Buying power has gone down. Bills are too high. Taxes are extremely heavy, around 50% on businesses, and the whole judicial system is messed up. Sounds like a lot of different companies we could talk about, countries we could talk about, which is why foreign investors aren't investing anymore. Big companies like Procter & Gamble, Shell, are leaving. Pakistan taxation has become such a burden that paying bills become difficult. Yet, despite all these issues, I still believe there are opportunities. They're great. Go after them. I did some research myself. I went to one of the biggest universities, and I noticed that almost every student there wants to go abroad, which doesn't surprise me. So there's a brain drain. Around 99% of them said they want to leave, whether they're graduates or undergraduates. It's said that around 1.5 to 2 million educated Pakistanis have already left the country. So while everyone else seems to be leaving, I still see opportunity here. Do you think that's actually a good thing from an investor's perspective, especially for an angel? It depends on the angel investor, depends on the investment. That's the only way you can answer that. The general statements aren't going to help you. You have to look specifically at what you're doing. Every situation has opportunities and threats to it. You have to look at your specific situation and understand it. Do I think? Yeah. So I think I answered the question. I hope that helps. Okay, next question we have. And this is from our Zoom audience, which means it's part of my Zero to Pitch audience. If you want to be part of that group, over my left shoulders, just scan that QR code. You can learn about the group and hop on in. And in that group, which is the paid group, by the way, we have daily office hours. You actually get to talk to me, not just listen to me. Daily office hours in about an hour and a half from now. It's fantastic. We work on everything from people's pitches to businesses to answering questions about their business. You name it, we deal with it. It's a great group of people. Should I show my pitch deck to everyone, like potential co-founders? Absolutely. I can't say it strongly enough. Emphatically, absolutely. You should absolutely do that. I did that. You have to sell people on your business. You have to get people excited about your business. You can't hide your pitch from people and expect them to take the risk and join you. This is sales. full on. And to be a great CEO, which I assume you want to be, you've got to become a great salesperson. And part of selling is we have to sell when we're thinking externally. There are two main groups we have to sell, and they're more than this, by the way. But the first is investors, because they're the people that are going to give us money to grow our businesses. The second is employees and potential employees. You've got to sell these people on what you're doing. Every single one of them you have to do this with. So yeah, you absolutely want to show people your pitch deck. Don't hold back. Share the whole thing. There's nothing in that pitch deck, I can guarantee you, that's that proprietary. And the reason I say this is, here's the simple test. If somebody could steal your idea, steal your business from just reading your pitch deck, you don't have much. It can't be that easy to do what you're doing. If it is, change what you're doing. I hope that helps. I'll go to my next question in just a second. So let's, if there are questions for me and you're watching on Zoom or YouTube, you can put them in the chat box. The Zoom audience gets the preference. So next question from our Zoom audience, because they are my group of people in my group, Zero to Pitch or Zero to Pitch Gold. Next question. How much time should I spend with a co-founder before hiring him? Okay, you want to know the answer? I'm smiling as I say this. As much as necessary. Co-founders I'm assuming these are more, these are going to be the executives on your team. These are going to be the people that you're relying on, to do everything that you need to do, to get things done. These are the people that are going to set the bar for everything that goes forward. So usually this isn't like one 1-hour meeting and somebody agrees to join your business. So it may take multiple meetings, multiple conversations. They may have objections, concerns. You want to spend time with them. By the way, think of it like dating. You don't usually get married on the first date or after the first date. It would be very unusual. It takes multiple dates before you propose. And a co-founder is kind of like a spouse. And in some senses, it's a more intense relationship than a spouse. And you should treat it the same way you would treat a marriage, with that same seriousness, because you're putting your life, your business life, so to speak, in their hands. And they're putting their life in your hands. It's a pretty serious deal. Remember, 50% of these relationships at least go bad and fail. And I know this from my own personal dealings with founders. And I know it from my own experience as a founder. So you should expect that the relationship is likely not going to work out. And you want to do everything humanly possible to make sure that doesn't happen. So spend as much time as necessary, not just to get your questions answered, but to get their questions answered. Because if it's not a good deal for them, then you don't want them. And you're better off, both of you are better off moving on to the next thing. So I hope that answers your question. Okay, if you have questions for me, you can put them in the chat box on Zoom or YouTube. I'm going to go back to my question log here. Let's see what we got. Give me a second. All right. Let's see what we've got for other questions. Okay. It's a good question. I see I got another question in the Zoom group as well, which I'll get to in just a second. Who shouldn't you raise money from? Okay, this is a really interesting question, since I've actually written about this. So I'm going to do my best to answer this. So they're kind of like three groups of investors, and I know that everybody kind of has this idealistic vision that that investors add all this great value and everything else. This is something I can remember a conversation I had with my dad before I started my company, and I was telling him my grand vision of we're only going to take money from tier one VCs and all this stuff. And my dad, who had started two companies and had some experience in this area, started laughing at me. And he was laughing in a nice way. He wasn't laughing to laugh at me, but he said to me, Brett, everybody's money is green. And I was arguing with him at the time about it, but my dad was right. Everybody's money is green. And when we really think about what's the goal, what's our real goal here, the real goal, it's hard to raise money, as many of you are going to learn. And the real goal is just to raise the money. So when we think about that, they're kind of like three groups of investors. One group we want to avoid. There are the two groups that we're okay with, are just the first group is the people that just write the checks. And this is going to be the majority of investors that are just supportive of your company. They're not going to add any value. They're not going to detract, and they just keep writing checks as you need checks. These are great investors to have. Nothing wrong with them at all. Then there's going to be the second group, which would be the sliver group. 10, 20% of all investors are in this group. And these are the people that are going to add value beyond writing the checks. The supposed alleged tier one VCs, even though I would tell you from experience, not all quote unquote tier one VCs are like this. Some are in the bottom group, which I'm going to talk about in a second. So avoid those people. We'll avoid the bottom group. But look, when you find these people that add value, embrace them as well, because they're going to write you checks and they're going to do more for you. But really, if people just write you checks, that's a win. You should be thrilled if this happens. So what's the one group we want to avoid? The destructive investor, the investor that pulls their support for your company and maybe even does worse than this, beyond pulling their support for your company. Maybe they sit there and make it almost impossible to invest in your company. That's the group, the destructive investor. And the tell on these investors, by the way, if you're wondering, well, how do I know if they're going to be destructive? Well, sometimes these investors have reputations. So you can look at their reputation. That's one way. But observe the behavior of the investor. Let me go back to my dating analogy. The dating analogy doesn't just hold for co-founders, it also holds for investors. Investors are courting you. They're on their best behavior before they write the check. So we, founders, should observe the behavior. And when you start seeing bad behavior before they write the check, that's when you should be concerned. So I hope this helps. All right, let's go to our next question. Okay. All right, it's not a question, it's just a statement. Okay, let's go to the next question. Hi, Brett. To raise pre-seed funding of, say, 1.6 million, what do you think is the bar ATM revenue, unpaid pilots? Okay, I think what you're saying is how much traction, which means revenue, do you need to have? That's a great question. It's going to vary, is what I would tell you. It could be you need no revenue. It could be you need no unpaid pilots. Or it could mean that you need a reasonable amount of revenue. The more money we're raising, typically the more revenue we need, the more things we have to show, or we need to show to be able to, to be able to raise the money. So it's very hard to give a very specific answer because there is none. It's going to vary from industry to industry, company to company, in terms of what we're doing. If you let's say, because it's hard to read into what you're worried about from just the question. Let's say that you don't have any revenue, you don't have any unpaid pilots, which is also possible, and you still want to get funding, Well, what do? You make the rest of your company better, which is, by the way, the goal always. Keep thinking about how you make the company better. Who else can I add to the founding team? What other accomplishments can we do moving towards pilots, moving towards an MVP, moving towards a first product? Think about all these various things that you can do to keep making the company better, because it's not just revenue. It's going to be revenue plus team plus product plus differentiation. All these various things are what's going to allow you to win. And the more of these things that we stack up, the bar keeps getting bigger and bigger and bigger and stronger for us. And it gets easier for investors to say yes, which is what we want. Okay. Next question. I've noticed that investors often come in waves, or investments often come in waves. For example, like how funding suddenly poured into AI startups recently. Yes, it's what's called the herd mentality, which you see a lot with investors. Do you think it's better to wait for such a wave of investor interest before launching something big? Or should I start now and, as you say, make progress first? Because when the money needs to come, it will come anyways. I believe you go when you go. I don't think you should try and time the market. I think it's a fool's errand to try and time the market. When you're ready, just go. And the market is what the market is. You won't know because the problem is there's so many different factors which move the market one way or the other, that trying to time it, it's just a fool's errand. You'll never get it right. So don't even try, because if you think about it, even if there's the herd's moving this way, let's say the economy suddenly starts going the wrong way, that can affect the market. There could be some unforeseen event that could affect the market. For example, I heard stories from people right around 9/11 in the United States. Would tell stories of how they had funding before 9/11. They were trying to close right around 9/11. The funding went away because of all the market uncertainty. You can't guess these things. So just go. Don't wait, go. That's the smartest thing in the world you can do. Okay, let's go to our next question. I am pre-product stage, building an AI fashion assistant app. Congratulations. We have a stellar team of PhDs, Amazon executives, etc. Awesome. We pitched to 10 plus pre-seed for $300,000 with no luck. Decided to build first and then raise. Is that okay? Yeah, it's okay. It's also 10's a very small number is what I would tell you. It's a tiny number in today's world. You probably don't know this. Maybe this will help you understand why it's a tiny number. The number for angels, this is angels and VCs, typically for every 100 face-to-face meetings that an angel or VC takes, they'll invest in one company. You're at 10. Yes, I think it's great to assess. And I think this is a really smart idea, is go out to a small group of investors. 10's a nice number. Get some feedback. See if you get reasonable feedback from that. Adjust. Go to another group. Adjust. Go to another group, etc. It sounds like, from what I'm reading into what you're doing, it sounds like you've got a really good team around you, which is to go to the previous point I was raising about there are all these different factors that lead to funding. Having a great team around you helps. It makes the revenue perspective and the product perspective less. So keep working. So what I would be doing in parallel with all these things is, number one is look at the people you're talking to on the investor side. Are they the right people? Because maybe they're not. And maybe you need to make some adjustments based on that. That's one thing I would do. The second thing is keep making the company better. And then go out to more investors. Learn. No is only no for today. You can go back to people too as the company gets better. It works. Okay. All right, let's go to our next question. Raising pre-seed funding of $200,000 at a $2 million, I'm thinking it's a $2 million valuation. Okay, that's what you're trying to do. Really scratching our head about what our valuation should be, since investors are negotiating down to 1 million. What's the story we should feel? Okay, how should you feel about this? Okay, here's the thing about valuations. Think about the stock market as the analogy here. They're buyers and sellers. Somebody's buying something, somebody's selling something. If you're the seller, there's got to be a buyer. The buyer is the investor. There has to be an agreement between buyer and seller on what the price is. The market sets the price. The market is the buyers. The only way you're going to be able to get the price that you want, if you want to get a 10% for 200K, which I don't know, I could see that. I could also see, you're showing 20% as the other option here, which is it 250 or 200? I think it's 200,000. That's possible too. It's gonna vary by market, by customer. This is fairly normal, is what I would tell you. So if that's what the market says and this is what you need to do, I'm a pragmatist. If I'm hearing this from investor after investor and I like the investor and there's value in these people and they're going to be supportive of us, I take the money. But that's me. Next question, how much equity should we be diluting at pre-seed? Okay, then there's a follow-up question. As I said previously, the market sets the value. So the market's going to determine, what your startup is worth, and that's going to determine how much equity you're going to give up. That's the simple answer. What other traction metrics matter apart from revenue? The thing about early stage investing is it's extremely mechanical. And by mechanical, the investors need to own a certain percentage of the company to make the investment worth their while. So while we think, oh, I've got all this revenue, so therefore I should have a higher valuation, maybe not. The investors have to own a certain percentage of the company. That's the thing you have to think about here, and you have to understand. The market sets the value. The only way that you're going to be able to influence and get a better valuation for your company is by having competition for your deal, which means you have multiple investors competing at the same time. The other thing I would warn you about, and there's another option here, by the way, you could do a safe note or something like that, where you essentially delay the valuation to the next round of funding. That's another way to do it. And for angels are usually pretty okay with doing safe notes. So that's yet another option for you, is to do that. So you have options here, but there are other things on term sheets that are important beyond the price. You have to look at the liquidation preferences. That's a massively important item in terms of the way that is structured. And there are other terms beyond that. The final thing that I would tell you is, and I recognize that it costs money to do this, but it's the best money you'll ever spend, is you want a lawyer that's experienced in doing these types of deals, working with you, because this is how you keep yourself from getting screwed. Okay, let's go to our next question. Do investors who said no to you at pre-seed and seed stage change their mind? The answer is yes, they do. I've seen it. I've had it happen. One of my first investors passed on us 3 times before they said yes. I had to think about that for a second, but so yes, people do change their mind. And no, here's the thing. Remember this saying, no is only no for now. Tomorrow, the world can change. Something's changed in your business, it's gotten better, added new people, whatever. Suddenly people get interested again. No is only no for now. Next follow-up question to this, is it worth keeping them in the loop about our progress? Yes, but I wouldn't do it, to a huge amount. When you have major news and you're ready to talk to these people again, that's when I would do what I would call the non-follow-up follow-up. which, let's say that you added a new vice president who's a real heavy hitter in your industry. You could let them know, hey, we just added person X, and this person's really great, has all this fantastic experience, blah, blah, blah. You don't even have to ask for the meeting. Because if they're interested, they'll say, great, can we meet? If you've added a bunch of customers, added a bunch of revenue, added a major customer, you can always go back and do that. So think about positive developments in your business. That's the way to do this. Okay, let's go to our next question. Where would you recommend to go for fundraising if you are a hard tech company? Seed stage from Canada, no luck here. Okay, if I'm a seed stage company and I'm doing hard tech and I'm in Canada and I can't find Canadian investors, then I would go south of the border to the United States. You want to, when I think about the way to look for investors, I think about geography, which is what you're mentioning. So let's focus on geography first. So let's go find, and you want, proximity matters. So you want as close in proximity as possible to you. So absolutely, I would, if I'm in Canada, I'm going to start in Canada to the person asking me questions in Pakistan. If I'm in Pakistan, I'm going to start there. Because geography matters, especially at the beginning of these companies, because people want to be able to check in and drive to your facility. There's a famous Marc Andreessen quote that you can look up, which talks about, if he can drive there in his Mercedes in like half an hour, then it's worthwhile to invest potentially. And while he meant it as a joke, there's a lot of truth in the comment too. Investors like proximity, even in today's world. So that's the first thing. The second thing is stage of investor matters. You cannot get a late stage investor to invest in your early stage startup. Will not happen, full stop. They're just different animals. The third thing that matters, since we've gone through geography, we've gone through stage, the third thing is, what are you doing? So let's say you're a fintech startup and you're talking to investors that invest only in medical companies. The medical investor is not going to invest in your fintech startup. Full stop, not going to happen. So we need to find the intersection of these three things, right? Somebody's going to invest in what we're doing in our area. We'll invest in our stage and invest in the geography that we're in. That's the world. That's what you need to find. The best place to go look for that if you're trying to build a list is Crunchbase. That's the best place. They have a free 7-day trial, which you can use. You can build up everything you want probably in that 7 days. Crunchbase.com. Okay, I've got time for a few more questions. Let's see. If I secure €1 million, okay, cool, you're in Europe. That's nice to know. Non-binding contract. Oh, this is interesting. Based on a promise to deliver, what might that meaningfully support fundraising efforts? Probably not a hell of a lot. I think it's great you got the contract, but it's non-binding, right? And you have to deliver. So it's great you have the deal. Investors are going to discount it because it's not real until you actually deliver and until they start, sending you money. That's the problem. So I know it's kind of like I'm the bearer of bad news on this one, but these kind of like LOI type things or whatever, they're not worth a hell of a lot. It's great that you have it. Better to have it than not. I would certainly tell people that you have it, but it's until they start paying you, it's not worth anything. That's the deal. All right, when am I going to do pitch deck reviews? I'm going to do one next week, as a matter of fact. Next Wednesday, October 15th, at this time, I will be doing pitch deck reviews. You have to be part of my group, though, Zero to Pitch, to be able to do it. If you're not part of Zero to Pitch, you cannot get your pitch deck reviewed by me. Those are the rules, but I will be doing one. The preference will go, I'll probably do 6 pitch decks in an hour. And the preference will go to people that haven't sent me their pitch decks previously. So I want to give everybody a chance. It is a great way, by the way, if you're interested in working with me at a deeper level and you kind of want to understand how I work and the value of what I'm doing, it's a great way to kind of see what it's like to work with me, at least in a unidirectional way and in terms of the advice that I'm going to give you. So anyways, I look forward to seeing you all next week when I do that. Okay, next question. This may be our final question, actually. So actually we got another, okay, we got a question on the Zoom end, which means they're part of the group already. Where can I find a good CTO? And who should I avoid? And what should be my criterion? Well, I don't know where you should find one. I can tell you the basic answers is ideally it's in your network. The network always first. People that you know is where you start. Ask everybody that you know. It's just like with trying to find investors. Same thing. Who do you know who can help me? I'm looking for a great CTO who does this, this, and this. Who are they? Do you know anybody? Ask those people. They say they don't. Then the first thing I would do if everybody who says no, do you know anybody who might be able to help me find these people? And then you just keep doing that over and over again. The second thing I would do is I would go on LinkedIn and start looking there and build a criterion of people that fit what you want. That's the second thing I would do. And from that, hopefully you have a group of people. And then you just start interviewing people. And what are you looking for? You're looking for people that have done it before, have experience, know what they're doing. You want to ask about how they're going to build their team, right? Because a CTO, this is your technology person, right? Could be CTO, VP of engineering, whatever we're going to call this person. That means they've got to build a team. Who are, if they have experience, who's coming with you from your existing company? They should have a following. If they don't, red flag. Second question would be, okay, how are you going to build your team? I want to listen to this. The more detailed the answer, the more logical it is, the more likely it is going to be that I'm going to feel good about them, since I want to understand how they're going to build the team. Then on the flip side of this, which is, okay, how are they going to manage the organization? Tell me how you're going to manage the team. How are you going to manage projects? Tell me about a successful project that you've managed previously. What went right? What would you do better? Tell me about a failed project. Where'd you go wrong? And what would you do? So those are, off the top of my head, a bunch of questions that I would ask of any candidate. And by the way, it doesn't matter what you're looking for, be it a VP of engineering, CTO, VP sales, VP marketing. You can take these questions and adjust them to any of those roles. Okay, this looks like it's probably our last question of the day. So let me answer it. What's my opinion on subscribing to these paid angel platforms for fundraising efforts as a first-time founder? Most of it is cold outreach, since warm intros are quite difficult to get. I don't really think much of them, to be honest with you. I think, I'm sure, I guess I'll call it this way, buyer beware. That's probably the best way to think about it, is that probably most of these aren't very good. Maybe 1 out of 10 is good. So if you find one that's good, great, but most of them are probably going to waste your money. So, and if you're looking for how to write a cold email, I have done videos on this that you can find on my channel, and I would follow them, and hopefully that will help you. And every 4 months or so, I do a training on that, which is more detailed. And if you join my group, over my left shoulder, right there, my left shoulder, Zero to Pitch Gold, there is a training in the classroom section there, which you can follow. It's a 1-hour training, and it'll walk you through exactly what to do. And then you can ask me any questions you want in office hours and be up and running. All right, we're at the closing hour for today's session. Next week will be pitch deck review. Cannot wait to do it. And if you want your pitch deck reviewed, you can join Zero to Pitch and get it reviewed by me next week. So thank you all very, very much. Take care, and I'll see you next week. Bye.